not only are they buying more physical gold into their central banks, but they're repatriating it out of London and into their own possession. And to me, that's probably the most significant part of the movement that's going on with Eastern Hemisphere central bank accumulation. They're not leaving it in custodial vaults in London or at the Fed.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for November 22nd through 29th, 2022, while supplies last. This week we have two great ways for you to stack silver ounces: kilo bars from the Nadir and Valcambi mints. Our kilo bars are 32.15 troy ounces of silver. Both are 3/9 fine or 99.9% pure, and both are individually serialized by their respective mints. The bars from the Nadir refinery in Turkey are available at $3.50 over spot per ounce, while the Swiss Valcambi bars are $4 over spot per ounce. Both bars are LBMA approved and suitable for IRA storage. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you. And have a happy Thanksgiving.
This is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me back on, Elijah. It's always a pleasure.
Well, it's great to have you. I wanted to have you back on. We've seen such a rally recently in the last couple weeks with the gold and silver markets. What do you make of this, and do you think these prices will hold?
I mean, no one knows for sure. I mean, all you can do is just kind of look at the fundamentals and look at the technical variables, and kind of just assign a probability to it. I'd say I personally think that the probability that we'll be higher than where we are now by the end of the year is higher than not being higher than where we are at the end of the year. Certainly, I think within the next 6 months, at some point, these central banks are going to flinch on their monetary tightening policy, even though it's not really that tight anyway. I mean, the balance sheet reductions have been minimal, almost insignificant, although it is affecting bank reserves and deposits and banking system liquidity. But I mean, the Fed funds rate is still at least 50% below just the headline CPI rate. And in order to try and accomplish what they're trying to accomplish just by raising rates and not unwinding QE aggressively, they're going to have to take the Fed funds rate higher than the nominal rate of inflation. So, and if they're going to use the CPI, that's not going to do the trick, right? Because the real rate of inflation is higher than what the CPI shows. So, but nevertheless, I think at some point in the next 6 months, we're going to see the Fed flinch, whether it's reducing the rate of Fed funds hikes or, after a couple more, say it's time to pause, because by then the economy is going to really be in the toilet. And that's going to act like rocket fuel for gold and silver. But that said, I did an analysis for my latest mining stock journal. And I unfortunately, I can't share all the details yet because I just created an article out of it for Kinesis Money, and I can't really go public with it until it publishes. But I showed how over really since, I guess, March, the price of gold has been tightly correlated with the directional movement of the S&P 500, and that's hedge fund driven for the most part. At some point, I think we're going to start to see, and a similar thing happened in 2008. I think at some point we'll see the precious metal sector diverge positively from the stock market, because the stock market is going to continue going lower. I'm certain of. But at some point we'll see the prices of gold and silver diverge positively and move higher, and that could start to happen before the end of the year. I mean, certainly in 2008 it happened at the end of October. So starting at the end of October. So I think that's how we're going to how this will unfold going forward.
What will cause that for gold and the S&P to kind of disconnect there? Because as you mentioned, they have been really moving together recently.
It could be any number of factors. I did in fact, it's on my blog, a couple articles ago where, I mean, no one really knows for sure what the trigger was in 2008. I mean, yeah, the Fed had said it was going to start printing money, do its QE program, and that was partly the trigger. But I don't know that you need a resumption of QE for that to happen. I think, especially with what's going on in the cryptocurrency world, I think we're going to start to see a movement of capital into more traditional forms of wealth preservation, and that would be gold and silver, whether it's physical gold and silver or the derivative investments like the ETFs or whatever, futures, that type of thing. And as we start moving higher, and we've started to see it already, the hedge funds on the COMEX have been net short gold and silver. And as it moves higher, their algo programs will tell them to cover the shorts and then start to move net long. And I think that's one of the factors that'll drive it. It'll be momentum based at first.
And there has been a move into gold from the central banks. We just got numbers out. The official numbers are about just under 400 tons of gold accumulated in 2022 by the central banks. But you've made a point on your website that these are really vague numbers and could be a lot higher than this. Can you expand on that?
Sure. I mean, I think most of the central banks, other than the Fed and the People's Bank of China, honestly report their gold holdings. But China, I mean, first of all, it's all the gold that's produced internally in China goes to the People's Bank of China. And then but the only way to track additional gold that goes into China via imports is reported, the gold that moves through Hong Kong, like mostly comes from Swiss refineries. And China in 2014 opened up Beijing for gold importation. And I think they import gold through Shanghai. Those numbers don't get reported, and that was done intentionally. And I actually have an article saved from back then from it's called the China Morning Post or something like that. And it specifically said in one of the bylines to the article that it was done in order to keep what, the total amount of gold that's moving into China and moving into the central bank, to cover it up to some extent. So I think China's been accumulating a lot more gold than, well, obviously they have than what they officially report. I mean, it's many, many multiples of that. So, and I haven't seen reports on it, and I haven't bothered to dig around for it just because I'm not that interested in it. But I suspect the Middle Eastern governments are accumulating a lot more gold than people are aware of.
And what do you think the reasoning is behind this mass accumulation of gold?
I think first and foremost, it's wealth preservation. And, when you read articles about smaller, more volatile economic countries, countries with more volatile economic systems and monetary systems, and they start, I think it was maybe Nigeria, that was the most recent one in Africa, and it said that they were increasing their gold holdings to stabilize their currency. So I think not so much the West, but I think the Eastern Hemisphere and that kind of economic and geostrategic bloc of countries, the BRICS, the SCO, the member countries of the SCO, I think they're, and I have no idea under what time frame, but I think they're moving toward resetting the global monetary system with something that will include gold in the basket that backs the currencies, the value of the currencies.
That is definitely the rumors we're hearing about the BRICS developing a reserve currency and possibly it being gold backed. Can you expand on kind of your opinion on that?
Oh, I think it's been. I think that's been going on for several years, and that's why. I mean, Russia went through a period over the last couple of years where, for a while, they were the largest. Their central bank was the largest accumulator of physical gold in the world. And China, I mean, who knows how much they've actually accumulated over time. And you're seeing a lot more of the East Asian. A lot of them are kind of or countries that used to be part of Russia, and they've been, not only are they buying more physical gold into their central banks, but they're repatriating it out of London and into their own possession. And to me, that's probably the most significant part of the movement that's going on with Eastern Hemisphere central bank accumulation. They're not leaving it in custodial vaults in London or at the Fed.
I know I just interviewed Bob Moriarty, and one thing that he mentioned about moving back to some sort of gold-backed currency, it's not that countries want to do it, but they're going to be forced to do it. What is your perspective on that? It seems like, precious metals are really the only real money, and people wake up to that.
Well, I mean, at some point, we're all the fiat currencies, it's like a race to zero. It's been going on for a long time. It takes a long time for monetary systems to destroy themselves and for there to be a shift into a reset monetary system. So, and I think we're coming to the very end of that, and who knows how much longer it's going to take. But yeah, I mean, they're being forced to do it because fiat currencies, once again, as they have all throughout history, are going to fail.
Now, at the same time, while we're hearing rumors of like a gold-backed currency being developed, we're also blatantly and overtly hearing that central banks across the globe are developing, digital currencies, and even the U.S. has done that now with the Fed testing a digital dollar. So it seems like that kind of currency would not be gold-backed, at least from what we're hearing.
I don't know. Well, the Feds won't be, but certainly I've read plenty of reports and analyses that suggest that the digital currency that ends up being rolled out by the Eastern Hemisphere Consortium will have a gold backing to it. And I think that's part of the reason they're accumulating as much gold as they are. I mean, there's been, since I've been involved in the precious metal sector, going back to 2001, I mean, there's been a long-term massive transfer of physical gold from the Western central banks into the Eastern Hemisphere. And it's not just the Eastern Hemisphere central banks back there. I mean, if you recall, I think it was maybe 2005, and I don't hold me to that date specifically, but at one, up until that point, China had restricted its population from owning gold. I mean, they could own silver, but not gold. And they opened up, they made it legal for Chinese citizens to accumulate gold. And I think that's been part of a long-term plan, because we know the Chinese like to play the long game. I think that's been part of part of their long-term plan for this shift to a reset monetary system that would have a gold backing of some sort.
As we're talking kind of about a sound currency, right? Sound money. It's something that you can hold in your hand that never falls to zero. We're hearing news recently of something completely kind of the opposite of that in the cryptocurrency sphere, where we have the FTX exchange going under, and many investors, wondering, are they going to be, are they left holding the bag at this point with nothing there? Your perspective on that whole debacle we just saw?
I mean, if you keep your Bitcoins or whatever your crypto flavor of choices on in the custody of an exchange, yeah, you're going to lose it. I mean, FTX isn't the only crypto exchange that's imploded over the last couple of weeks. So, I've never I was never sold on cryptocurrency and Bitcoin. And I said from the beginning, it smells like a Ponzi scheme to me. And that's what it's turning out to look like. And it's not my unique or original thought. There's plenty of really bright people who came to the same conclusion as I did. And part of the problem, especially with the cryptocurrency exchange networks, is there's a massive amount of leverage embedded in those current in those exchange networks, and that was never supposed to be part of the whole narrative of cryptocurrency was that it's a limited supply, you can't lever it up. Well, guess what? Of course you can lever it up when you start trading it via these exchanges, and the exchanges have been incredibly unregulated.
No, when it comes to, I guess, cryptocurrencies in general here, then a lot of people have talked about Bitcoin being like a digital gold, but do you think this particular circumstance shows that it's not, or is it just that, people use this particular exchange and, it doesn't really say anything fundamentally about Bitcoin itself?
Digital gold was a fancy marketing term that caught fire. Oh, this is digital gold, it's the new gold. No. What it means to use gold and silver as wealth preservation assets and as flight to safety assets is you have possession of it yourself in your hand. I mean, how do you have possession of a Bitcoin? Yeah, you might have a purse, but it's still it's still got internet counterparty risk. And what happens if the power grid goes down or governments decide to highly restrict usage of the internet? You don't have access to your Bitcoins. Yeah, you may have your stupid digital blockchain crypto key or whatever, but you're not going to be able to spend it if you can't get on the internet. And that's just one aspect of it. But I mean, again, it's just, to me, it's fundamentally flawed thing. I think it attracted the fascination of a lot of highly intelligent, tech geeks who thought, oh, this is going to change the world. Well, it is changing the world, but yeah, it's basically been it's transferred a lot of wealth from a lot of people to a very close knit group of people. Primarily the original guys who got in there and started marketing these things and have been collecting money from investors.
Now, one last market I did want to discuss today is the housing market. You've been reporting a lot about this and how really the expectations of home builders are plummeting as we speak. Your perspective on current home sales and the current state of the real estate market?
Sure. I mean, this is, the last two housing bubble / collapses. You had one that was in the late 80s, early 90s. And that was tied into, the Drexel S&L Ponzi scheme that was going on at the time. And that inflated housing. It made money cheap and you could lever up and buy homes, and but a much smaller scale than what we saw in the 2008 bubble crash. And this is just another wash, rinse, repeat cycle of that. It's fostered by easy monetary policy, central bank money printing, the complete debasement of credit standards, and the housing bubble that we just witnessed that came to an end. And it really, if you look at the charts of the home builder stocks, really came to an end in late 2021. This housing bubble dwarfs the scale of the 2008 housing bubble and the early 90s housing bubble. So I think the unwinding of this bubble is going to be a lot worse than what we saw in 2008. So, and if you look at a chart of home sales and home prices, I mean, the market kept declining until about 2010, and then it went sideways until about 2015. And that's when the Fed money printing really started to kick in. And that's also when the U.S. Housing Authority, FHFA or whatever it's called, that's when they lowered the lending requirements to get a government guaranteed loan. And they started bringing down the requirements, the down payment requirement, the debt to income ratio requirement, the form of the down payment requirement, et cetera. So I mean, people say, oh, well, and we don't have subprime loans, like subprime mortgages like we had in 2008. Well, in fact, a lot of the Fannie Mae and Freddie Mac loans that have been issued would have been deemed to be subprime 20 years ago. So, like I said, it's old wine in a new bottle. And this time, the wine is a lot mustier and the bottle's a lot bigger.
Now, it seems, what you're saying is that this housing crisis will be worse than in 2008. And in 2008, we saw the housing crisis really reverberate throughout the financial system. The financial system is so interconnected that, sectors that seemingly had nothing to do with housing were impacted. So what do you think it will be like this time?
Oh, well, I mean, that was primarily a credit mortgage housing bubble back then. I mean, there was a stock bubble, general stock bubble. But we've had an everything bubble, and it's not just the housing market that's going to implode the system. I mean, we're seeing, the damage that the implosion of the cryptocurrency exchanges is going to cause. And it's not just that, it's basically everything. I mean, you're at record levels of household debt, that's auto debt, credit card debt, personal debt, mortgage debt. It's going to be a lot more devastating and widespread this time.
And how will it impact the average person then? Because I know in 2008, it devastated a lot of people. And it seems like if it's going to be worse, then people better prepare for this.
It's going to reach higher up into the income and wealth demographic. So that, I just read an article and it talked about real disposable income for, the average household. And there is no real disposable income anymore for the average household. So, and we haven't even talked about layoffs. Layoffs are just now starting. I mean, we've seen the tech sector announce a lot of layoffs, and I know Ford has announced layoffs, is in a layoff program right now. But at some point, the layoffs are going to start to snowball. We'll have a snowball effect, and it's just going to be a mess.
And what is the best way to prepare in your view?
I mean, take whatever cash you have that you don't need and you're not going to need over the next year to pay your bills, but et cetera, and just buy as much physical gold and silver as you can, and don't worry about the premiums. You don't have to buy silver eagles. You can buy silver maple leafs, you can buy silver philharmonics, and those have much lower premiums on them than silver eagles do, and it's the same. It's they're 100% silver. It's the same thing. It just has a different stamp on the front and the back. And also, buy some gold if you have, enough cash. And for that, same thing, 1 ounce sovereign minted bullion coins, whether it's gold eagles, maple leafs, philharmonics, just whatever your favorite coin is. I personally like the Chinese pandas. So whenever I see the premiums come down on those, I usually buy some.
All right. Well, Dave Kranzler, really appreciate your time today. Before we let you go, where can our viewers find you? And did you have any last thoughts for our viewers?
My website's investmentresearchdynamics.com, and I'm on Twitter. And on my website, I've got links to my mining stock journal and short sellers journal, and you can see what those are all about. And in terms of last thoughts, I mean, I hope everyone has a happy holiday season. And don't sweat out what you can't control, because what's coming down the pike at us in the financial system and the economy, you have no way to control it. And so just enjoy what you can while you can, as much as you can.
All right, Dave, once again, thank you so much for your time, and happy Thanksgiving.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.